All right, so Lee, we're living in the present right now, but we got to go back to history just for a second. This is some data from Bespoke. Since 1952, after two-day drops of 10%, or these are the periods we've seen two-day drops of 10%, October 87, Black Monday, November 2008, the Great Financial Crisis, and then March of 2020, COVID. With that precedent right there, should people be doing something with their 401k? Should you be adjusting? Should you be doing anything?
It depends. Hopefully you've got a portfolio that's designed to have stress tested what you're comfortable with. When we work with clients, we go through an exercise to figure out how much of a drop they can be comfortable with. Now, if it turns out that you're not comfortable with what happened last week, it's okay to go back and reassess some things. And if that is the case, yeah, you can go ahead and make some tweaks.
All right, so, I mean, who could be comfortable with what happened last week, Lee? I think everybody's a little uncomfortable, especially if you have your money in a 401k and you have any plans to retire in the near future. So clearly, everybody's not in the same boat. There's some people who are younger and have a longer horizon, people who have a shorter horizon. But is there any, and it's hard to say one size fits all, but is there any general rule or any good advice that people should do? Should you at least reassess what you're doing? Should you possibly change the balance of stocks to bonds? Is there any other advice out there you can give?
So we believe in reassessing things, even with clients that we've had for years. Every few years, we like to reassess where they are because things change over time, not just the markets or not just the economy. How close are you to retirement? Has your life situation changed? And so when those things happen, we have to make some assessments. These portfolios that we set aren't static. The other thing that changes is the ability for our clients in particular to be able to access different parts of the markets. Myself and most other advisors that I know are more and more allocating things to what we call alternatives. We're using a lot more products that are, I'll describe them as being new-ish, defined outcome products like buffered ETFs. And so you've got to make those changes as they become available.
So, Leah, let's dig into this really quickly. We picked out some buffered ETFs that we're going to look at. One is the S-Max compared to the S&P year to date. So the S-Max is the iShares Large Cap Max Buffer ETF. When you look at it, the S-Max is only down just about 2% or so, while the S&P is down more than 16%. I think the question for a lot of people is it limits the downside, but what about if the market snaps back? If you're in these buffered ETFs, what then?
It's going to limit your upside, right? But what the conversation we've been having with our clients is, listen, I know you're getting nervous, and we had some of these clients as far back as 2 months ago, but I know you're getting nervous. Here's some of the trade-off. We can limit that downside for you, at least for a portion of your equity allocation, but you have to look me in the eye and tell me that you're comfortable that if this happens, the market snaps up and we've got another 20+ % year on the S&P 500, that you're not going to get mad at me that that slice of your portfolio is only up 15, perhaps 17%.